So we can start now. So let me first of all welcome Mr. K Sinha, Chairman Business Standard, and Mr. UK Sinha. Mr. Nainan will be chairing this afternoon's Wednesday seminar, and one can say that possibly he is the most distinguished economic journalist we have in the country. He has, he's currently, as I mentioned, chairman of Business Standard. He has edited India Today, Economic Times, Business World, Business Standard, and someone whose thoughts and comments are followed very closely. I was telling him that every Saturday, weekend ruminations is one column. It's essential reading, at least for me, and I always benefit a lot from that. So thank you, Mr. Anand, for agreeing to chair this afternoon's session. We are also very fortunate to have Mr. UK Sinha as our distinguished speaker this afternoon. As you know, Mr. Sinha was chairman of SEBI, Securities and Exchange Board of India, from 2011 until 2017. He retired only recently. And before that, he was also CMD of UTI Asset Management Company. He was in charge of the capital markets in the Ministry of Finance. So, once again, there are very few people amidst us who know as much about capital markets in India as UK does. And I requested him that he should look beyond India and also offer us a comparative analysis of capital markets, financial markets in India and China, which he has kindly agreed to do this afternoon. So now I'll pass on the baton to Mr. Nanan to chair this afternoon session.
Thank you, Mr. Pat. One of the ironies of India is that we have a terrible civil bureaucracy, but great civil servants. And the other irony is that while the Indian Administrative Service is essentially generalist in its ethos, Mr. Sinha is a specialist. So, given those two unique characteristics of an outstanding civil servant and a specialist who's worked in government on policy, he's worked as a fund manager, he's worked as a regulator. So he has a unique sort of 360-degree view of capital markets, and today he will bring that all those perspectives to bear on a subject that is not often discussed and which is fascinating because it's vital to understand what's happening not just to China but to the world around us and what might happen. So with those very few words of introduction, welcome, and my thanks to you for giving me the opportunity to be here. Over to you, Mr. Sinha.
Thank you, Mr. Nanan. Thank you, Mr. Kant, and thanks to everybody who has been kind enough to come and listen to me. Thanks for inviting me here. I will be talking about the capital market in China and make a comparison with the Indian system. The focus will be on comparing the regulatory environment in the two countries. But I'll begin by talking about the macroeconomic scenario, because some of the points which we are going to discuss will emanate from those discussions. So, if you look at the economic growth in China, it has lifted 800 million people out of poverty, and it had a growth rate of near 10% between 1978 and 2014. The per capita income in dollar terms has jumped 49 times, from $155 to $7,590. Its share in global manufacturing went up from 7% in 2000 to 25% in 2016. And in 2011, it overtook the USA being the world's largest producer of manufactured goods. If you look at how it happened, one of the points is that the infrastructure investment, which used to be $33 billion in 1985, it went up to $1 trillion in 2015. It's a different matter that they have ghost towns, they have ghost roads on which there is no traffic, but infrastructure has been developed. Now, how they have done, one is that, of course, the infrastructure development. The second point I would like to make is that they had much lesser compliance on labor and environmental laws. The child labor use and the environmental issues were really not the highest priority. They also had a number of protectionist strategies in trade. They really benefited from their entry in WTO in 2001. But they had a number of policies to subsidize exports, subsidize trade. For example, they had this export tax rebate policy, which was introduced in 1985, and VAT was 0%. They also had strong currency controls. It was estimated that in 2005, the Chinese currency was undervalued against the dollar by as much as 30%. So this was the type of currency control that they had. And the intellectual property regulations were very lax. In fact, every forum you go outside, you find that, at least till a few years ago, that how products were copied and the protection to foreigners about their intellectual property was much less. Now, while all that has happened, the current issues are about demographics. The size of the labor force participation has almost plateaued in around 2016. Wages are rising, and in fact, between 2011 and 2016, in 5 years, the average workers' wages have risen by 65%. And in dollar terms, the wages there are now comparing with some of the East European country wages. So the type of wages in some of the weaker European countries are prevalent. That is the type of wages that are there. And they also have a very strong feeling and fear of capital flight. And I'll talk about capital flight later as well. But to give you an idea that between June 2015 and January 2017, in 18 months, their forex reserves fell down by $1 trillion. So from $4 trillion, it came down to $3 trillion. And of course, we have the scenario where they are having a falling GDP growth. Their debt burden as a country is approximately 300% of the GDP, and it's rising. And there is also a worry that does it reflect the complete picture? Is it the final picture when we are talking about 300% of GDP? Of the debt burden of 300%, around 125% is on account of corporations which are non-financial corporations, and 65% of financial institutions. So corporates have around 190% of the GDP as their own debt, and government and households have the rest. So this is something which is quite high. Non-performing loans are again very high. It is estimated that the non-performing loans in the banking system is around $5 trillion, just the non-performing loans, which is almost equal to 50% of the GDP. If we make a comparison of China versus India, the key indicator, here we are talking only about the GDP. So we can see that the GDP growth rate has been coming down, and India has, at least in the period that we have here, today the Reserve Bank of India in the afternoon has come out with their forecast about Indian GDP and GVA, which they have reduced it from 7.3% to 6.7%. But the short point here is that over a period of time, the Chinese GDP has been going down. If you look at the GDP, China is 11.4 trillion and India is 2.25 trillion. GDP per capita, earlier we had a number of 7,590, that was for 2014. So 2016 it is $8,260. India is $1,718. They have a reserve of 3 trillion and earlier they had a high reserve of 4 trillion, but they lost about $1 trillion in 18 months. India 372 billion beginning of this year, now it has crossed $4 billion. They have a trade surplus of $38 billion. India has a trade minus, we don't have a surplus of $10 billion. And these are the population numbers and the median age. Now we'll talk a little bit about the market per se. So they have the Shanghai Stock Exchange, SSE, and Shenzhen Stock Exchange, the SZSE. Both of them were opened in 1990 as part of Deng's policy of reform and cleanup. Actually, Shanghai has a very old history of having a stock exchange and stock trading, going down to 1800s, early 1800s. But everything was closed down in 1949 or thereafter. So finally, it was started again in 1990, and they created the Shenzhen Stock Exchange. The market capitalization in July 2017 was around $8 trillion. But companies can also list on Hong Kong Stock Exchange. And the Greater China, if we also count the Hong Kong Stock Exchange, that is SSE, SE and HKSE, Shanghai, Shenzhen and Hong Kong all put together, the Greater China market cap is around 12 trillion.
Does that have double counting?
It doesn't have double counting, but there is a scope of double counting because let me come to the last one about A shares and B shares. There are multiple types of shares in the Chinese market, and then I will come to your question. A shares are those companies which are incorporated in mainland China, and they can be traded only in Shenzhen or in Shanghai. So either SSE or SZSE. And they are, by and large, they are very big companies, and domestic investors are encouraged to trade there. Till a few years back, foreigners were not allowed to trade there. They have a program called Qualified Foreign Institutional Investor Program, QFII, where there is a quantitative ceiling. So, as of now, in A shares, the foreigners have about 2% of investors. Earlier, if you are a foreigner and you wanted to invest in the Chinese market, then you have to buy the B shares. B shares were shares of a Chinese company listed in either SSE or SZSE, but the trading was in Hong Kong dollar, in Hong Kong. So, to Mr. Nainan's point about double counting, the foreign analysts, they don't count the market cap, they count the market cap of A share. They say that the best indicator is of the A share, and the A share market cap is $7.3 trillion. So to come to a number about the market capitalization of Chinese stocks, if we look at the A shares, that is about $7.3 trillion. They also have other class of shares, for example, Hong Kong shares. So a company can directly get listed in Hong Kong, and there the trading happens in Hong Kong dollars. Those are called H shares. Then a company can get listed in New York, and they are called N shares. Then there is an L share for companies which can get listed in London and things like that. In 2014, they also tried what is called Shanghai Hong Kong Connect. So this Connect came out with a lot of fanfare. They said that why should anybody have to go and trade in Hong Kong? You can trade from here, and vice versa. But because of certain design issues in that Connect, it has not taken off. The design issue, for example, of those who are interested was whether the settlement should be on T plus 0 basis or T plus 1 basis, or the issue also was about when should the payment be made, what should be the disclosure requirement. So there are uncertainty about these issues, so this has also not picked up. And all these decisions have been announced at the highest political level. For example, the Shanghai and Hong Kong Connect in 2014 was announced by President Xi. And again, in 2016, they came out with another connect, that is Shenzhen and Hong Kong. That has also not taken off. So by and large, a good indicator of the size of the market would be the A shares. In Shenzhen, there is a main board, and then there is an SME board, and there is a China Next board. So there are 3 boards. Main board actually mainly has companies which were state-owned enterprises, public sector companies. So state-owned enterprises are trading and registered on the main board. What they call as SME, and it was started in 2004, is actually not an SME board, although they call it. Large companies which are not state-owned enterprises, they are listed there on the SME board. And China Next is like something for startups, for new technology companies, for innovative companies. And here they have given some freedom about the conditions for listing. And there are about 11,000 companies listed there in China Next, but their combined market cap would be $500 million. Now, in any system like this, normally there should be a system of migration from one board to another. To give you an idea, in India, we have a policy of having a separate platform for SMEs, the small and medium enterprises, which is actually a platform for SMEs. Bombay Stock Exchange has about 200 companies, NSE has got about 30 companies. And once they attain a certain size by market cap, they have to migrate to the next level, because the idea is that they must then be more compliant. SME has lesser compliance requirements, and large companies should have more compliance requirements. They don't have any such plan, but there were news reports saying that they are now thinking in those directions, and they might have it in due course. They also have a over-the-counter platform called NEEQ. NEEQ is basically a pre-listing platform where the prices are negotiated not in the open system, in the anonymous system, but these are it's a negotiated system. NEEQ provides also an opportunity for some of the new generation companies to come there, and SME platform, SMEs companies, they take advantage of it. So it forms some sort of a pre-listing platform that once you have come on NEEQ, and by and large on NEEQ, only institutional investors are there, retail investors are not there. And earlier when we were talking about 98% domestic and only 2% foreigners, unlike India, a very large portion of this 98% are actual retail investors. In India, we have very few actual retail investors buying and selling shares in the daily market. The government and the regulator encourage them to come through, say, a mutual fund. But there, most of the people buy and sell directly, and that is one of the reasons of the problem which they had in 2000. The Ministry of Finance, Asset Supervision and Administrative Commission, General Administration of Industry and Commerce, China Banking Regulatory Commission, China Insurance Regulatory Commission. And the important point I would like to make here is that in India, the regulators, IRDA, RBI or SEBI, have functional autonomy. By functional, I mean that if they want to pursue a matter, they want to pursue a case, and they have got enough material or evidence before them, they can pursue that case. They don't have to seek anybody else's approval or go to some other forum. Here what has happened, that CSRC has got two commissioner's office, one in Shanghai and one in Shenzhen, and they have got 36 bureaus in various countries. In those counties, the 36 bureaus, by a government decision or decision of the state council, on every matter, they have to have a coordination, and an inter-agency coordination mechanism has been formed. And this mechanism includes, for example, representatives of the Ministry of Public Safety, representatives of the Ministry of Finance, representatives of the Ministry of Commerce, tax authorities, excise authorities, and of course the banking regulator and others. So what happens in this situation, that every action that has to be taken, even at the local level, or which has to be investigated or examined at the local level, you have to keep all of them together. So my argument is that this leads to a lot of politicalization in individual decision making. And our system in India is vastly different from that. The initial public offerings, in India, we do not have a system of what is called approval. We have a disclosure based, so it is quicker, less expensive. In China, everything has to be approved by the CSRC. The trading system and risk management, in India, it is highly sophisticated. And when I say it is highly sophisticated, it's not because I have worked there, it is because the International Organization of Security Commissions and the International Monetary Fund, IMF conducts a periodic assessment once in 5 years called Financial Sector Assessment Plan, FSAP. In FSAP, they have rated India as one of the 4 best in the world. So they have 4 points. So India has scored 4 out of 4. And only 4 countries could score that. Whereas in China, when the trading system will start to function, when it will be stopped, what is the risk management requirement, that is not very evolved. And more than not being evolved, it is also not very predictable. As we go forward, we'll talk of some of the examples in 2005 summer of what happened in China. It's entirely because of these things that they do not have a rule-based system of how to manage the risk management and the trading system. In India, we also have the central counterparty, which is independent of the stock exchange. It's a separate entity. Corporate governance is very, very elementary in China, whereas India has been ranked as number 13 by the World Bank in the shareholder protection. Enforcement actions in India are quite transparent and predictable, whereas in China it is opaque and unpredictable. We'll talk about certain developments which took place in China. And here let me give you some background. Post the global financial crisis of 2008, various countries had various programs of stimulus. India, for example, went for a lot of fiscal steps. Either the taxes were reduced or forbearance was given or expenditure was enhanced. In China, majority of the stimulus or action post the GFC was through the banking system. Majority of it. And the second problem was that the loans given by the banking system to the state-owned enterprises was mostly to state-owned enterprises, because most of the corporates which were taking loan, they were owned by the provincial government or even the central government. So at some stage, they decided that they must take measures so that the share prices of these companies go up. And once the share prices go up, they can be listed on the stock exchange, or you can divest some shares, and thereby they can raise capital. And this realization came sometimes around 2012-13, that they should try to ensure that the share prices go up, so that these companies can be listed at a very high and respectable valuation, and their debt ratio can be reduced. Now, how do you as a country ensure that the prices go up of share market? First is that you start creating a lot of hype, you start making statements, you start talking of the market, and also you start leverage buying. So ordinary Chinese people were encouraged to take loan for buying shares, which is a very, very dangerous thing. And when people realize that at some stage that the market has been overbought, then it crashed, and it crashed suddenly, and it crashed by a huge amount, huge percentage. Now the problem is that when this crash happened, the measures that were taken were heavily interventionist. For example, there was a feeling that the secondary market is falling because IPO market is booming. So people are selling their shares in the secondary market, in existing shares, and taking this money to buy in the new IPOs that are going to come through. So what they did, they banned the IPO for 4 months. So no company can raise an IPO. Now we can't imagine that in India or in many other parts of the world. You can't just ban IPOs. But they did that. And then they suspended these, I'm sorry, this word is not supervision, it is suspension. Suspension in the trading of shares of more than 1,000 companies. At one stage, half of the market was closed. They said, no, you are selling, so this company share will not be sold. It was taken out of the market. It was taken out from the trading platform. In India, neither the Ministry of Finance, nor SEBI, nor RBI can stop the trading in a single script. We have such a tight rule. There are rules around risk management. For example, if it falls by a certain amount or goes by a certain amount, there are circuit breakers. They are rule-based breakers. Here they suspended half of the market, unheard of in any part of the world. Not only that, they said that, look, if you are the owner of the company, or you are a substantial owner, which means they defined as anybody owning more than 5%, they said you can't sell your shares. For 6 months, they were stopped from selling shares. Now what is a mutual fund? Mutual fund, it takes your money, my money, anybody's money, and then the expectation is that he is an informed investor, and he will take a call when to buy, what to buy, at what price to buy, what price to sell. But here, government and the CSRC said, ask mutual funds that you cannot sell for so many months. So if you are an investor in those mutual funds, your interests are completely compromised, and in a very, very unpredictable manner. So they said you cannot sell. Mutual funds were directed not to sell. And in this crash, almost $5 trillion of market cap was wiped out. Not only that, in order to talk up the market, state-owned funds, the nearest example in India, we often talk about the market is falling, that a phone call has gone from North Block and LIC is buying, or SBI is buying. Good old days, UTI was buying. But at least we had something to say that it was a phone call, not a directive. And it won't happen for months together. Here, directives were given to state-owned banks to buy stocks. Second bullet is even more worrying. That is, can you imagine, for example, in India, that the Central Bank of India, the Reserve Bank, will actually lend money to somebody to ensure that the market goes up, the Indian market goes up? Central bank money was given to a PSU called CSFC, China Securities Finance Corporation. And they were given money so that they could lend it to brokerage firms or to others to buy the securities, so that the market could be brought up. And they had limitations on short selling. And there were threat of arrests. And the regulator used the word malicious short selling. They said, if you are short selling, it is something malicious you are doing. And in that period, some foreigners went missing. Some securities executives, they went missing. And what where they were, the only explanation was they were reported to be assisting in investigation. When the 6 months period got over in January, remember for 6 months they said that you cannot close the market for 6 months and all that. So then they started, it had to resume after 6 months in January 16. So they introduced a circuit filter concept. It was at 7% of the fall or rise in the market. But it was so badly designed and people had so little faith in it that it failed on day one. And the market went down by almost 15% on the day that the circuit filter was introduced. Another thing which kept on happening in this period, 2012, 13, 14, 15, was that the peer-to-peer lending program went on in a big way. Bao is an example.
What is peer-to-peer?
Peer-to-peer is that I lend to some industry. I don't lend it to somebody who is an individual. I am a company. I have got money. I am lending it to another company. And how do I lend it? So a platform is being provided, and Bao was one such example that they were lending. It was through an electronic platform that it was happening. The problem in this was that, and when this bubble burst, people realized, and the fellow admitted, that actually he was arranging loans for companies which didn't exist. So loans were being given to those companies which didn't even exist. He was arranging loans for companies where he had direct interest. And $7.6 billion were lost and about 1 million investors were affected. The Chinese bond market is very large, around $3 trillion. And in December 16, about 8-9 months back, there were multiple examples of bonds being issued on forged documents and bonds being traded on forged documents. They were issued and also trading on forged documents. And when these issues were flagged, there was hardly anything that could be done. So there were 29 defaults. In 2015, there were 7 defaults. In 2016, there were 29 defaults. And they had companies were barred by this China Insurance Regulatory Commission from issuing universal insurance products or entrusted bonds. Let me explain what is entrusted bond. It's a very interesting concept. Because of certain prudential requirement, a bank or a brokerage firm has only X amount of leverage possible. If the capital is X, you can do 2X, 3X, but there are some limits. But they were having a play. So they were actually doing much more than that. So when the time to report comes, and it comes at an interval, say end of the month or end of a quarter, what they did, they entrusted these bonds to somebody else for the time being. So that on books they were completely within law and they could borrow more. And that exercise went on and on. And they had to finally ban it. These entrusted bonds were banned. And when they entrusted it to somebody, there was an undertaking, like any repo transaction, that they will take it back. So it was some sort of a bond repo done in a very, very informal manner. If it was small in size, nobody would have taken note of it, but it became very, very large. Then in 2017, they have started very, very tight control over investments abroad. If you see, they had given approvals. Like in India, we have an approval called the Liberalized Remittance Scheme, LRS, Liberalized Remittance Scheme. You and I can take out $200,000 every year outside India and then buy any capital asset there. They also have a limit of $50,000. But they were very easy routes to bypass all this. And when people realized after 2015 that things are not very good, so Chinese nationals, they started taking out money in a massive way. And some of it was on personal account, like tourists going and spending vastly different amount per capita than they were doing 2-3 years ago. There were news items that Chinese tourists are the biggest buyers and things like that. Then the companies, the corporations in China, they started making all sorts of investment abroad. So in January, February 2017, they have brought in tighter controls. For example, some company went and bought a very famous Hollywood studio. So they said, no, you can't buy a Hollywood studio and things like that. Another worrying thing is that while most of these things were happening in mainland China, in Hong Kong also things have not been very good in the recent year or so. For example, Huishan Dairy, I'm very sorry for the typo, it's a dairy, it collapsed and it dropped 90% in value for no apparent reason in one single day. One large company, Huishan Dairy, 90% market cap was lost. They also had a number of companies where there was simultaneous price crash in June. I'm talking of Hong Kong. So it happened, and both the March episode in Hong Kong and June episode in Hong Kong, there has been no apparent explanation, no apparent economic explanation of why it happened. But it did take place. You'll be surprised that for securities market violations, around 200 people have been arrested since 2015. There is a person called Xiao Jinhua. He is the 32nd richest man in mainland China. His assets are around $6.5 to $7 billion. He was abducted from Hong Kong, mind it. Not that he disappeared in mainland. He was abducted from Hong Kong, primarily because he was supposed to be very close to the promoter of Dalian Wanda, a very large conglomerate working in various areas. So suspicion was that the Dalian Wanda group has transferred a lot of money outside. So this fellow can be helpful in cracking that. And earlier, some of the executives of GSK, Rio Tinto, Crown Casino, they have been detained. And in June, that is hardly 3 months back, they had a major crackdown on AmBank. AmBank is a large insurance company. Earlier we were talking about these entrusted bonds, and there is also something called universal insurance, which was actually not an insurance product. It was designed to be actually a debt product where it could be repaid in 2-3 years. So you floated that, used that money, you got that money, and you used that money for investment outside. Then DNA, Fosun, all of them had similar problems. And in May 2017, Moody's have actually downgraded China. So from all this you can make out that foreign investors are very uncomfortable, but there is also a question of too big to ignore or too big to exit. I'll also like to tell you that in several international fora where I had occasion to participate over years together, everybody used to talk about it in whispers. Nobody, even none of the multilateral agencies like IMF or World Bank criticized it to the extent that it deserved, in my opinion. If India had done even one half of this, we would be seriously criticized. So that is one mystery, but maybe it's because you are very strong, you can get away with it. Another thing is that the financial markets have become very, very politically sensitive, because the government or the political leadership doesn't want retail to lose money, or after that episode of Ezu Bao, there were protests in certain cities in China because those people had lost money. Similarly, every 5 years, like on 18th, they have their state council meeting, 18th of October. Every year, 5 years when this meeting takes place, sometimes in the month of July, they have this conference called National Financial Work Conference. This is normally attended by the Prime Minister. but this time it was attended by the Prime Minister. By the President. And there are two quotes which are there. These are two of the quotes that he made. Finance is blood and pulse of the economy, and financial security is a vital part of national security. So he's given a very strong message that financial stability will be maintained at all cost. It is as vital as national security. And he also announced a few other announcements, other measures. So my conclusion is that the regulation of the financial markets in China will continue to be more politically directed. All indications and past developments point out toward that. And you and I know what is happening in India, so you can make a good comparison. Thank you.